The stock of Creative Media and Community Trust Corp., trading under the ticker CMCT on the NASDAQ, is currently sitting at $4.32 per share, representing a massive intraday surge of 35.42% as of midday trading on December 22, 2025. This sudden explosion in price has caught many off guard, especially given the relative silence surrounding the ticker in recent weeks. While a 35% gain in a single session usually suggests a major fundamental breakthrough, the reality for CMCT is far more nuanced and perhaps more precarious than the green screen would lead you to believe. For the average investor looking at this move on a platform like the Robinhood app or through their interactive broker's trading account, the temptation is to view this as the start of a long-term recovery. However, the disconnect between this price action and the underlying fundamentals of the company is where the real story lies. We are seeing a classic tension between market momentum and structural reality, and understanding that gap is the only way to navigate a micro-cap REIT like this without getting burned. The standard narrative for CMCT over the last year has been one of survival. Most investors see a company that has been struggling with high leverage and a pivot away from its traditional lending business toward multifamily residential properties. The expectation was that this transition would be slow, painful, and likely punctuated by further stock dilution or reverse splits. But today's price movement challenges that expectation. When you see a stock jump 35% on significant volume, over 46 million shares traded today, compared to a typical average volume of just 2 million, it forces a rethink of the immediate catalyst. The reality is that CMCT has become a vehicle for extreme micro-cap volatility, often driven by short interest positioning rather than a sudden shift in its balance sheet health. While the company did recently announce the completion of its 1915 Park apartment building in Los Angeles and the strategic sale of its lending division for $44 million, those developments were already mostly baked into the valuation. Today's move looks more like a liquidity event or a short squeeze in a thin market. If you are managing your own individual brokerage or using tools like Schwab Intelligent Portfolios to diversify, you know that commercial real estate has been a minefield. CMCT specifically has faced immense pressure because it sits at the intersection of office space, which everyone is fleeing, and multifamily housing, which everyone wants, but which requires massive capital to scale. The company's net loss in the third quarter of 2025 was over $17 million, and its net debt still towers over its tiny $4 million market capitalization. This is a staggering ratio that usually keeps institutional investors at a distance. Yet the intraday movement we are seeing suggests that retail interest, perhaps fueled by social sentiment or technical breakouts, is currently the primary driver. People see the $4 price point and think it's a bargain because the 52-week high was once over $70. But that high was before the weight of high interest rates and operational losses fully set in. Comment below how many shares of CMCT you currently hold, or if you think the commercial real estate sector is finally finding its bottom. When we look at institutional activity, the picture is equally complex. Fidelity Wealth Management and other large-scale asset managers often avoid names with this level of volatility and negative funds from operations. However, for those engaged in online investing through more aggressive channels like SoFi Active Investing, CMCT has appeared on several high-volatility scanners. The reality is that the sale of the SBA lending division, which is expected to net about $31 million in cash, is the only reason the company has the breathing room to continue its pivot. That cash is vital for completing the renovations on properties like the Sheraton Grand Sacramento, which saw its income drop significantly during the construction phase. Investors often mistake a cash infusion for profitability, and that expectation is likely what's fueling the current buying spree. The reality is that the company is still burning cash from operations, and $31 million only goes so far when you have over $500 million in debt. Creative Media and Community Trust Corp operates as a real estate investment trust that primarily targets creative office spaces and multifamily assets. Their business model is built on the idea that high-growth industries like tech, media, and entertainment want vibrant work-life environments. This is why they focus on markets like Los Angeles, Austin, and San Francisco. In theory, this is a smart play. In practice, the timing has been difficult. The shift towards hybrid work has decimated the demand for creative office space, leaving many of their properties underoccupied. For example, their office portfolio was recently reported as only 73.6% leased. That is a tough number to sustain when you have preferred stock dividends to pay out, which they have continued to do for their Series A and Series D holders. This creates a situation where the common stockholders, the ones trading CMCT on the NASDAQ today, are last in line for any actual value. Recent stock movement has been a roller coaster. Just earlier this month, the stock was hovering near its 52-week low of $2.56. The current jump to $4.32 feels massive in percentage terms, but it still leaves the stock down nearly 90% over the last year. This is the hallmark of a dead cat bounce or a speculative rally. For those who use Fidelity Investments or the Fidelity mobile app to track long-term trends, the chart looks like a series of lower highs and lower lows. Each time the stock spikes, it eventually settles at a new lower floor as the reality of the earnings report sets in. The expectation today is that this 35% gain signifies a turning point. The reality is that until the company can show positive core funds from operations, which were negative $10.5 million in the most recent quarter, any rally is built on sand. Looking at the broader landscape of investing sites and self-investing platforms, there is a clear trend of traders looking for the next big thing in depressed sectors. Whether you're trading Apple stock, Tesla stock, or Nvidia stock, the common thread is growth. CMCT offers the opposite, a turnaround story. Turnarounds are notoriously difficult to time. The company is betting heavily on its multifamily segment, where net operating income actually did increase by $600,000 recently. This is the reality that the management wants you to focus on. They believe that as they finish their developments and move into 2026, the cash flow from these apartment buildings will finally offset the losses from the office side. It's a race against time and interest rates. If the Federal Reserve continues to keep rates elevated, the cost of servicing that $500 million debt will continue to eat any gains made in the residential sector. The future outlook for CMCT depends almost entirely on its ability to execute this liquidity plan. The sale of the lending division needs to close without a hitch, and the proceeds need to be deployed immediately to reduce the most expensive layers of their debt. There is also the risk of further share issuance. When a microcap stock jumps 35% in a day, management teams often see it as an opportunity to raise capital by selling more shares into the strength. This would be great for the company's survival, but terrible for current shareholders, as it would dilute their ownership even further. If you are using a Fidelity trading platform or searching for investment help on how to handle a volatile REIT, the best advice is often to look at the enterprise value versus the market cap. When the debt is this much larger than the equity is essentially a call option on the company's survival. There is also the matter of the reverse stock split. Shareholders recently approved proposals that give the board the power to consolidate shares. This is usually done to keep the stock price above the $1 minimum for NASDAQ listing, or to make the stock look more attractive to institutional buyers who avoid penny stocks. While it doesn't change the underlying value of the company, it often leads to further selling pressure as retail investors exit before the split takes place. This is another area where the expectation of cleaning up the share structure often meets the reality of signaling weakness. If you are managing your portfolio through SoFi Invest or looking for the best investing sites to research these moves, pay close attention to the filing dates for these splits. They are often the precursor to the next leg down in a struggling stock's life cycle. To summarize the central insights of today's action, we have a stock that has surged over 35% to $4.32 on massive volume, yet the fundamental picture remains extremely challenged. The expectation of a recovery is being driven by recent asset sales and a pivot towards multifamily housing, but the reality is a balance sheet burdened by $500 million in debt and a recurring net loss. This tension creates a high-risk, high-reward environment that is more suited for day traders on the Interactive Brokers platform than for long-term investors looking for stability in their Fidelity brokerage accounts. CMCT is a classic example of why price action and value are not always the same thing. The surge today provides liquidity for those looking to exit, but it doesn't yet provide a floor for those looking to enter. Ultimately, the authoritative take on